Welcome back. Can't remember a more dramatic backdrop for a Reserve Bank policy. Rupee falls 5% in a year when all other comparable currencies are up against the dollar. Also, it is the second consecutive year of current and capital account deficits, or most likely so. Of course, we have one more quarter to go. Now, will this impinge on the MPC when it makes monetary policy on December 5th, or will the huge GDP number of the second quarter, 8.2%, have a bigger impact? Joining me to discuss rupee rates and RBI is a former MPC member, well-known economist, Dr. Ashima Goyal, and V Lakshmanan, the head of Treasury at Federal Bank. Ashima and Mr. Lakshmanan, thank you very much indeed for joining me. Ashima, the question really is to you. First, you've been through so many rounds of MPC meetings. When something as dramatic as this happens on the currency, it's almost a no-holds-barred fall. Will that get more importance than other variables?
Well, the MPC under flexible inflation targeting is not supposed to look at the rupee, only at inflation and growth. And I think last year there was very little movement in the rupee. And this regime, they have taken the call to let it float with market movements, but preventing the old, for a long time, RBI's policy has been to prevent excess volatility and persistent real misalignments. So I think they still come in when it is getting too far away from equilibrium. So, and this regime is working. They have reserves and other ways of intervention. So the interest rate is not tied to the rupee. The interest rate has to respond to domestic inflation and growth.
Okay, no, I agree that the Reserve Bank and the MPC members have repeatedly said that they are an inflation targeting central bank, and it will be governed by domestic factors of inflation and growth. But this is dramatic enough to upset growth calculations as well. It will impinge on inflation to some extent because imported elements are going to become expensive. So it's not that it doesn't have a macro impact, and it's also a financial stability question now. When given the rapidity, it's a 2% fall almost since November 18th. When the October trade deficit was announced, we realized it is a one-month high, and since then it's been a near 2% fall. So won't this make the currency take center stage because of financial stability issues?
Right. As I said, they do intervene against excess volatility, and we've seen some recovery from the lows it had reached as the RBI has come in. And, I have been watching the rupee and the economy for a very long time. I remember the 2000s when it first appreciated. Markets they couldn't believe what was happening because through the 90s it had depreciated. But, I have seen always, crises like the global financial or taper tantrum, that it passes. And there is a reversal of the outflows. And most of these outflows are driven by global events. And the reserves are used and other policies are used to smooth rupee volatility. And then whatever loss of reserves there is made up later on.
Okay.
And reserves remain very, very high. In fact, the IMF thinks we have too much of reserves. We should let the rupee move more. So I don't think there is any sort of major financial stability concern here.
Just yet. Okay. Mr. Lakshmanan, what are your treasuries awaiting from the Reserve Bank? Will you all want a statement from the RBI governor on the currency? Will a rate cut make it a little worse? I mean, I know people don't come to us because of the rate differential, but in this year, debt flows are positive, equity flows are negative. Will a rate cut make even debt flows negative? Can that be a fear?
Yeah, so thanks for having me here. Firstly, alluding to the point which Madam Ashima Goyal said, one, RBI has, of course, never really brought in currency as a core factor in its monetary policy statement dissemination. A side eye would always be there. To which extent the policy will definitely take cognizance of that, and to which extent a rate outcome that's going to come later this week will definitely be looked into. Having said so, in as much as we as bankers may wish a commentary on the currency to be brought out, I would state that yes, the fact that the rupee has weakened above 90 would be noted, but the policy statement would clearly again hinge upon the broader parameters of inflation and growth in the wider statement that's going to come by. And that is, I think, is going to be
Kind of a statement. What kind of a statement are you expecting, Mr. Lakshmanan, from the governor on the rupee? What kind of a statement can boost or help the market, you think?
No. So one, again, as I stated, I don't think there's going to be a boosting statement coming in from RBI in any manner on the rupee. Okay. It's just going to record the fact that the rupee is weakened beyond 90 in any fashion, if at all, to the maximum. Nothing beyond that, in my view.
Okay. No, in about 2-3 policies earlier, the governor actually made a very strong statement saying that we will not tolerate speculation or something, and it had a positive impact. I can't remember whether it was the June policy, but there was a very strong policy. Ashima, to come back, wear your economist hat and let us know, not as an MPC member, will we reach a stage where we may have to announce, the kind of extraordinary bonds we announced in during the taper tantrum time in 2013, asking for NRIs and others to invest money, or we did with the Resurgent India bonds after the nuclear test in 1999. Do we need any of these extraordinary capital measures?
That's always a possibility. As I said, intervention, there are many instruments there in the arsenal. But just to come a little bit to the communication point, which you were asking, Lakshmanan, I think that it is very important that the RBI indicates to the market that they are there to prevent excess volatility. Because initially there was a belief that there's much more volatility under this regime. The RBI is hands off, it's all market determined. But markets get, there is a trend following, there is excess volatility. And especially if it crosses 90, then markets start immediately. I mean, all of us, I think in psychology, we start thinking of 100. And there can be sort of excess movements in some direction. So a statement that the RBI is very much there in the market in order to prevent excess volatility should be calming for markets. And also they can underline if they want, although it's not the MPC's job and should not be there in the MPC's communique, maybe in the governor's statement, that the RBI has many instruments and this phase is likely to be temporary.
Okay. And now for the original question for which I invited you, the rupee became a sudden news point. We have this extraordinarily low inflation number and probably a FY26 average of 2% for CPI, and yet growth going great guns and not apparently even requiring any help. How would you vote?
Well, at the current juncture, I would vote. And, I've been calling for a rate cut for a long time, ever since August. I think 25 BPS rate cut should be there. Because, as you know, I've studied the real rate and its impact on the economy in the past, on an ex-post basis. Whenever the real rate has exceeded 2 for a longish period, it has had a dampening effect on growth. And moreover, in an inflation targeting regime, if inflation, you don't respond to spikes in inflation. Food price spikes you ignore. But this over-forecasting of the inflation rate has been going on since the middle of 24 almost. So it's persisting for a long time. And looking ahead, 9 months ahead, inflation is expected to be low. Therefore, under an inflation targeting regime, the room to cut rates should be utilized because monetary policy acts with a lag. You have to be forward-looking. There can be a dampening effect of high real rates down the road. Already October numbers are showing some slowing in industry, in IIP,
yes,
core industry, etc. So although the run-up to the festival time, the GST cuts did lead to a boost to demand, now the government cannot sustain it indefinitely if the RBI's monetary policy is restrictive.
Okay.
No, and markets get worried if the government is fiscal deficit and overall the government is still restrictive because fiscal deficit consolidation is continuing. When markets got worried when the tax cuts were announced and you saw rates tightening, hardening, G6 rates, right? So then it's the RBI and the government at cross purposes.
Okay.
Yeah?
All right. No, I take your point that inflation is requiring a rate cut. And the forward forecast of the RBI, there is a joke in the market that the Reserve Bank decides what policy it wants and then suitably forecasts a forward-looking inflation. So, from 3.7, they have come down to 2.6 and will probably go down to 2. So there is that kind of, a joke going in the market. Lakshmanan, now the more important question is clearly OMO. Reserve Bank has been intervening and supplying dollars, and it is going to supply or will be called upon to supply a lot of dollars. So liquidity tightness is written in the RBI's supplying of dollars. Do you think just a 2 lakh crore OMO, which is what the market is talking about, suffice? Or does the Reserve Bank have to give an indication of a much larger OMO to mollify the market?
I think for starters, having an OMO as an indication, I think will be a good beginning point in my view. And at least that will bring out very clearly to the market that RBI is looking at liquidity as a matter that would require support in more fashion. So even if a specific amount were not to be brought out, an ask or a statement of an OMO support clearly should be beneficial to the market is the way I see it.
Okay. Yeah, I'm sure they will make a statement. It is just that usually OMOs are not part of the governor's statement. Certainly not part of MPC, but it's not even part of the governor's statement. They usually announce it separately after putting out the statement. Maybe this time the governor makes an exception and speaks or at least alludes to government having to buy bonds, RBI having to buy government bonds. But it's going to be a nail-biting Reserve Bank policy for a whole host of reasons. Thank you very much, Ashima Goyal and Lakshmanan, for joining us and helping us parse or helping us understand what to expect. Markets still in a very troubled spot, whether you're looking at Forex or whether you're looking at equities. There is very little relief, 90 rupees and 10 pies to buy a dollar, a level which we didn't think even 1 week ago would be on the cards this quickly. Wrap up on Bazaar. On that note, Chartbusters coming up.